Get ready for more valuable financial insights from Northern California's premier retirement income planners, Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
Hi, this is Ahmad and Jim Files. You're listening to the Peak Financial Freedom Hour. We'd like to welcome you all to the show. We'd also like to say thank you so much to all the loyal listeners we have. We know people have been listening to us for years and years and years, gaining information. We find that out because then 5 years after they heard us the first time, they call in and say, hey, I would like to have an analysis. I would like you to give me a second opinion about my money. And as you promised, I'd like you to give me a free retirement income plan that I can review and see if it's for me and if I should implement it. So we like to tell you, make sure if you're thinking those things, please get a hold of us. Dial pound 250 on your cell phone and say the keyword money. Simply, you dial pound 250, send, and then when the recording comes on, you say the keyword money. That will put you in touch with our scheduling department, and they will get you set up on an appointment to meet with us to go over exactly where you're at. No cost, no fees, no obligation. It's that simple. And people say, well, why in the heck do you and Jim do that? And we do it because then we get in front of more people that might need our help. It also gives us a really good name out there in the community that we're not gouging people for fees, and we're never pressuring anyone to become our client. We're out here to give education information, and those people that want to work with us, they work with us. If you don't, it's okay. We'll part ways as friends, and you'll never feel any pressure from us. You can also listen to all of our past radio shows on our podcast. You can go and watch our radio shows on our YouTube channel, as well as probably 200 different videos, educational videos you can watch. No cost. You sign up, you have access. You also can go to our website and get a lot of data there, including downloading copies of our most recent best-selling book, Mama's Secret Recipe for Retirement Success. It was an Amazon bestseller. Jack Canfield co-authored that with us. He's the guy who wrote Chicken Soup for the Soul that sold over 500 million copies worldwide. And again, don't hesitate to call us about your questions and if we can potentially help. We find so many people right now, just so many people are worried about their money, which means they're worried about their future. And they want to find some type of resource that will educate them and give them information that they can sit down with and feel like the advisor is sitting on their side of the table. Well, we can tell you that's exactly what we do. We're really good listeners. We're going to act as a fiduciary for every single one of our advisory clients. I also have to follow the Certified Financial Planner Board of Practices, which is as stringent, if not more stringent than the fiduciary rule. So we're always here to help. And the whole goal is to put a plan in writing for you today. So Jim, why don't you start with a really good quote on something about money that we can lead into today's show?
You know, everybody that's getting close to retirement or in retirement, they're concerned about Social Security, right? If you haven't retired, you're concerned about Social Security, what it's going to be, will it go away? And if you are retired, you're concerned about what if I have a reduction in Social Security? This is a great quote that came out. It says, Social Security was never intended to be a retirement plan. At most, it was designed to provide an income supplement. In other words, if you have saved, $500,000 to $5 million, you know that Social Security is not going to take care of your income needs. It's just a supplement. And that is why you have to position your assets for income to make sure that, yes, Social Security is going to be a small portion of your income needs, but you need to take those assets that you've built up over the last 30 or 40 years, and you need to convert those into an income stream.
Well, Social Security, do you know what it was originally titled or nicknamed?
No.
Widows and orphans.
Oh, yeah.
That's
right.
what it was for.
Yeah.
Only for widows and orphans. And
yeah.
I think the tax rate back then on Social Security was like 1%, 2%. Now it's 15.3%, including Medicare.
Yep.
So it's such a huge amount because people got tired of paying in this extra fee for widows and orphans. And they said, well, we need it also. Well, then if everyone gets it, then the cost has gone up like 15 times for that, when it was never, ever, ever planned to be used for anything other than for widows and orphans.
Yeah. But everybody is planning to use it, right? If you're getting close to retirement. But it's not going to take care of all of your income needs. It's not designed for that. So you get two choices in retirement, and we're going to talk about those today.
And think about what you're saying there, and maybe just build this in. But Social Security now is leaned upon so much because pensions have been taken away from 19 out of 20 people.
That's
if it was
right.
40 years ago, almost 19 out of 20 would have a pension. Now 1 out of 20 has a pension. So how much more pressure does that put on them relying on Social Security?
And what is a pension? A pension is an annuity, right? That's what it is. If you read the paperwork, if you have a pension, it says it's an annuity. It's a lifelong stream of income that will never run out. And if you don't have a lifelong stream of income that will never run out, you're going to worry about your money. There are ways right now in today's environment where you can build your own pension if you don't have an employer pension plan. If you have a 401k plan or a 403b or a 457 or an IRA or a non-IRA plan, you can actually build your own pension. It's a lifetime income stream that will never run out. And maybe we can talk about that on this show today, Dan.
That'd be great. I think, the whole key is to allow Jim and myself to give you information that can hopefully provide you the first steps in reducing how much you worry about your money. And people ask, what we do. And I think Jim says it pretty eloquently. And he says, we're a risk mitigation firm that also creates dependable lifetime income. And I think that's exactly what we do. But then why do we do that? It's because our whole focus and that is helping you stop worrying about your money so much. And we know how much you worry about your money. That's why you're listening to the show. You don't listen to it just for your entertainment, even though Jim and I can be funny at some point. In most cases, we're giving you very, very, very hardcore, important data for you to understand what you need to do to make better decisions and avoid big financial mistakes. So let's look at then what retirees worry about. And I think it's important to understand we empathize, we understand everything our clients are feeling because we will help them vocalize that to us. We won't just give them, hey, here's what we do. We want to find out, what do you want your money to do for you? How do you want your assets to be used, not invested, but how do you want to use them for yourself, for beneficiaries, for charity, for long-term care, etc.? And because we ask these questions, we now learn what retirees are worried about. And we write a lot about that in our books, understanding that. So we put it on paper. We do a lot of videos. And no matter what, Jim, I think it's safe to say everyone who's retired or getting ready to retire, they worry about their money a lot. It doesn't matter if they have an advisor, they do it themselves. So let's ask, how would you respond to a viewer who might say, I'm not sure how much risk I'm taking, but I'm scared to death after suffering a big loss because I lost close to 50% back in 2000 and another 50% back in 2008. And I never want to go through that again.
Well, first of all, you have a good memory, right? And a lot of people don't have a good memory. They forget the same thing. They forget they lost 50% 2 times in the last 24 years when the market dropped over 50%. Because you're thinking about that and you're worried about that, that is a good sign because the market's at an all-time high. We've been in a bull market run for many, many, many years, and the market does not always go up. It will go down. And if you're close to retirement or in retirement, you better heed that advice because if you're not positioning your assets correctly right now, and the market goes down, and it can go down very swiftly. The market doesn't call us on the phone one day and say, hey, by the way, reposition your assets over the next 2 weeks because I'm going to go down. It just happens, and it happens suddenly. And right now, if you're getting close to retirement or in your retirement, you better have those assets positioned for a market downturn because it's going to happen. When, we have no idea, but it will happen.
Well, in this listener, they already lost 50% twice, and that means in their gut, they're thinking that can happen again because their portfolio, maybe it's a teeny bit more conservative now, but they still know there's a lot of volatility. So we can help. Dial pound 250 on your cell phone and use a keyword money, pound 250 and use a keyword money, because we can literally run an analysis for you, a free analysis that will show you exactly how much risk you're taking right now. Very simple. It'll show, boom, how much if the market goes up you'll make, but worse, if the market goes down, how much you better be prepared to lose. There's no cost or obligation. And if you're feeling that way, that most people are, you need to find out right now exactly how much risk you're taking, because if it's fine and you're okay with the amount of risk you're taking, you don't have to make any changes. But if you're 5 years away from retirement or into retirement, and we do a calculation and you are actually taking significantly more risk than you want to take at this point in your life, you have to make the changes that will allow you to reduce that potential risk, because a big loss, no matter what anybody says, a big loss could potentially ruin your retirement. You're back with Dan Ahmad and Jim Files, the Peak Financial Freedom Hour, and today we're talking about what retirees are worried about. And one of the things we just talked about, Jim, so I'm going to have you continue on, is I'm not sure how much risk I'm taking, but I'm scared to death about suffering a big loss because I lost close to 50% back in 2000 and again in 2008, and I never want to go through that again. One of the things I had said was we can do and we'll provide you a free risk analysis. Call in pound 250, say the keyword money, and we'll run an analysis to show you where you're at so you find out now how much risk you're taking.
The worst advice you can get right now as a consumer is if you just take this information, if you called your current advisor, if you have one, and your advisor says, don't worry about it, I have you positioned correctly, number one. And number two, even if the market go down, it always comes back. That's the worst advice you can possibly get right now because number one, the first comment I made is that don't worry about it. You're positioned okay. I have assets in asset classes that you won't suffer too much of a loss. That's probably not accurate. I'll give you an example. Just go back in your mind to 2022. If you had a balanced portfolio of 60% in stocks and 40% in bonds or funds, and the market was down about 20% at year end, that's the S&P 500, your portfolio was down anywhere from 16 to 24%. That was a balanced portfolio. And that wasn't a major market drawdown, right? The market only went down 20%. Now, fast forward, or go backwards, I should say, and what happens if the market goes down 50% again in the future, which has done it twice in the last 24 years, just going to take those same numbers. And what if you lost twice as much or 3 times as much of what you lost in 2022?
Well, Jim, I want to clarify something, then throw it back to you again. And what you said is 100% I agree with. You said that would be the worst advice you could get. But we have to add on to that at this point in your life, now that you're close to retirement, in retirement. It was not the worst advice. It was the best advice you could have gotten when you were young. If you're 25, 30, 35, or 40, you should have invested as aggressively as your stomach would allow you to do and looked for the long term because you didn't need to use the assets for 20 or 25 years. So that advice was 100% accurate. The problem is now those advisors that helped you accumulate assets, they continue to give you the same advice about accumulating assets during retirement, which is the recipe for flipping disaster because now you'll be taking so much risk. And the one thing that will derail your plans for retirement is going to be a large loss.
And the second comment I made was they'll tell you to stay the course, don't get out, the market will always come back.
Which is good when you're young,
Yes.
because it does happen that way and you're not using it for income.
That's exactly right. And we do believe that. We do believe long-term, the market will always come back. But how long will it take to come back? How much do I have to suffer when it goes down? If I'm in retirement or close to retirement and I'm drawing income off those assets, what other effect is it going to have on my nervous system? Because now I'm drawing money out at a time when the market's going down.
Well, it's not just your nervous system. What other effects is it having on your finances? Because that will then either force you to reduce your income, force you to terminate your income, or force you to run out of assets and income before you had planned to.
Now, we believe in the market. We divide money into buckets, right? And one of the buckets we divide money into is money in the market. We are using risk mitigation strategies. It doesn't eliminate risk. You'll still lose money. We're trying to stop you from losing a lot of money, but that's not all your money. That's just one bucket, Dan. And we have to position assets in other buckets to make sure you have safety and income so that when the market does go down, because it will, you're not panicking and it's not going to affect your lifestyle and it's not going to affect your income needs.
Well, think about it. Let's say right now you're driving around, you have no idea, but you probably have, if you have a diversified portfolio, stocks, bonds, mutual funds, whatever you have, and you're diversified, you probably right now have between a 30 and a 50% risk. What does that mean? That means if we go through another 2001 and 2 or another 2007, 8, 9 market decline, you better be prepared to lose 30 to 50% of your assets. And if you're 30 or 40, fine, we have enough time. I think you'll make it up no matter what. Then continue to be aggressive. If you're getting ready to retire the next 5 years and you suffer a 50% loss, so let's say right now you're planning to retire in 2029, 5 years from now, and you suffer a 50% loss between now and 2029, what's the chance do you think that you can retire in 2029? Zero. Right? So if you're in retirement and you suffer a 50% loss and you're using your assets for income, what's the chance you can continue to take the exact same amount of income and that your money won't run out? Pretty low. So we want to make sure then we take that into consideration that you now have to look at your money as what's going to provide you the income that's going to support your lifestyle.
Also, look at what's going on in the world right now. And for some reason, the stock market is oblivious to this at this point in our life. We have 2 major wars. We have the Middle East escalating. We have terrorist activity that's underground here in the United States of America. We have interest rate sensitivity. We have inflation. And we just had an election. And because of that, there's major concerns. Normally, you would see the stock market reacting, but it hasn't reacted. It just keeps on going up. But what goes up will go down. And if you're concerned like we're concerned as a consumer, as parents, about the market and about the fact that the market can be disruptive at any given time, you better have a plan in place. And that's what we pitch on this show every time. It's not where to invest your money, but have a plan in place and let the plan tell you where you should have your money. The plan will tell you how to position your asset for safety, income, and growth.
Well, for this one, number one, the guy saying, hey, I lost 50% in 2000, lost 50% in 2008. I don't want to do it again. The way to do that is exactly what you said. You have a plan. What if we put in writing? What if you felt that way, which you might? And we put in writing, if the market crashes 50% like it did in 08, here's the probability of loss. And it's not 50%, but the probability of your loss would be about 5%. So then if you have $2 million and you would lose 50%, you're losing $1 million. What if your $2 million is projected to have a 5% maximum loss, which means $100,000? How would that make you feel? And the simple question is, would it make you sleep better at night knowing you've reduced your risk from 50% all the way down to 5% and you've increased your probability of success? Because that 50% risk you're taking originally, it does not improve your probability of success during retirement. It decreases your chance of risk. It increases your probability of a higher potential return, but it decreases the chance your money will last for as long as you live, and you can take a significant amount of income off your assets.
The issue, Dan, everybody has right now listening is they really don't understand their risk. They really, the concept of risk has been kind of shuffled under the rug because you believe that, and you have for 40 years if you've been working, putting money into your retirement plan, and it has gone up for two reasons. Number one, you're making contributions of your own money. And number two, the market has gone up over a long period of time. But you're at a stage, if you're getting close to retirement or in retirement, to preserve those assets because you don't have the same amount of time to continue to contribute to that retirement plan. You're going to use those assets.
Well, think about it right now. Robert Shiller, Nobel laureate, economist, smart guy, he came up with what's called the CAPE ratio. It's a cyclically adjusted price to earnings ratio that then tells us, is the stock market priced as it should be? Is it too low or is it too high? If it's where it should be, fine. If it's low, you better be buying. If it's high, you better be selling, is what it pretty much shows. And if you go back to 1817, the average has been 17. Now the average is over 37, so more than double the risk. And every time it's happened, 5 times in history, over 30, the market has dropped 20 to 89% after it's happened. So right now you have to be wary of how much risk you're taking and make sure you get it in writing to show that you don't have to worry about things going forward. You're back with Dan and Jim, the Peak Financial Freedom Hour. Today, Jim, we are talking about what retirees worry about. And we talked about people that were worried. If you out there right now listening, say, hey, I'm not sure about how much risk I'm taking now, but I'm scared to death about suffering a big loss because I lost close to 50% in 2000. And again, in 2008, I never want to go through it again. I saw some tremendous volatility in 2022, so I'm worried. So we handled that. And it comes down to having a plan in writing. How about this next one? If someone says right now, my account really hasn't seemed to grow much, even though everyone's talking about the market being at all-time highs, and my broker keeps saying I should earn 8, 10, 12%, but I just don't think I've seen those types of rates of return in my portfolio over the last 5, 10 years. Our response is, as we reviewed portfolios for new clients coming in, they have not made 8 and 10 and 12% increases per year on their assets. And it makes sense because if you go back to 2000 and go all the way through the end of last year, the S&P 500, which is the largest 500 companies in the nation, only went up an average of 5.00% before fees and before income. So how in the heck is that ever going to get us to 8, 10, or 12? Then if you go back to every 15-year time period since 1996, the S&P averaged just over 5.6% before income and fees. So how in the heck is that ever going to get us to 8, 10, or 12%? So when your account hasn't earned as much as you thought, it's because that's literally what the market has done. You've taken so much risk for something that you don't feel is a good rate of return.
And look at the market right now. The market's at an all-time high. Based on those returns you just stated, Dan, do you think as a consumer, as a listener, that the market's going to go down? Yes, the market is going to go down. When? We have no idea. So we keep on preaching in the store on the show to make sure that you understand your risk, really have it in writing so that you can prepare yourself so that when the market does go down, yes, you're still going to lose money if you have money in the market. There's no way around that. But you can lose less money if you divide your assets up correctly now and have a full financial plan in place to know how you should position those assets for safety.
Well, think about it. Let's keep your current diversified portfolio that's in stock funds, bond funds, individual stocks, whatever it's in, that you really don't understand and really isn't separated out to provide you specific benefits. And then now you have to hope that everything's going to work. Well, if you go back to 2022, when both the stock market and the bond market had significant losses, your portfolio was not diversified because the assets acted the same way. What if you had three different types of assets? What if you had one bucket, the gold bucket, that's just liquid assets, bank, money market, CDs, T-bills, something that has no risk, no fees, and it's accessible and you don't have to worry about? What if you then had a second bucket that is our green bucket, and that's our guaranteed principal protection and guaranteed lifetime income bucket, and that then states you'll never lose any money if the stock market crashes, and you'll get a high level of income contractually guaranteed for as long as you live. And then if we use our third bucket, which is the red bucket, that's our growth bucket, we still have risk in that bucket, but we have the opportunity for the biggest rates of return in that bucket. If we now can use all three of those buckets, 95% of our clients, when we design a plan, let's say the average client came in with a 40% risk factor, meaning if the market crashes, they'll lose 40%. We have 95% of our clients at a 5% risk factor, meaning if the market crashes 50%, they still have to plan on losing money, but it's projected at a 5% risk level versus 50, which completely helps them get to that next level of worrying less about their money.
And the reason we can do that is if you think about what Dan just said, we had three different buckets. Bucket number one, we call the yellow bucket, money in the bank, cash, savings accounts, high yield accounts, CDs, treasury bills. If the market go down, you're not going to lose any money. You got money in bucket number two, the green bucket, the way we defined it, that's money where it's fully protected against stock market losses. You'll never lose money if the market go down. So those first two buckets of your assets, you cannot lose money if the market go down. Yes, in the third bucket, we're going to have money in the market. We're going to use risk mitigation strategies, but still you have risk. But you only have risk in that portion of your money. So when you divide this up and do the math behind it, that's how we try to get your risk down less than 10% and ideally around that 5% mark.
Well, and think about it. If we don't have a 40 or 50% risk factor and we have a 5% risk factor, do we have to earn the same rate of return and be as aggressive with the investments to make your plan successful? And it's simple math. No, we don't. Because if you have 50% risk, 40% risk in your portfolio, the only way to recover from those types of losses is to be extremely aggressive. So imagine you have $3 million and your money is invested moderate to aggressively, market crashes, you lose 50%, you lose 1.5 million. The only way to recover that extra $1.5 million of losses is to invest the remaining $1.5 million aggressively. And how willing, after you lose 50% of your money, are you really willing to then comfortably continue to invest on an aggressive basis? And the answer is going to be, you're probably not going to. The worst answer is you're probably forced to at that point.
Yeah.
So we don't want to be in that position, because if we have a 5% maximum risk level that we're quantifying, we don't have to earn huge rates of return. We just have to earn moderate rates of return, which isn't that what most people we meet with want now? They want to minimize how much they could lose, and they still want to earn a decent rate of return on the upside, but they don't have to go for the huge high risk types of rates of return.
Yeah, getting back to your comment, if you lose half your money or 40% of your money when the market crashes, you have to be aggressive to stay in that position to try to get your money back. And you don't want to be aggressive. You're older, using those assets for income. And what happens, which didn't happen 15 years ago when we had a market crash, is that you start making bad decisions, because when the market goes down, when you are retired or close to retire, you will not stay the course. You will get out. You will get out at the wrong time. You may never get back in, and then you have a massive loss to your portfolio. So the psychology behind retirement planning is not only putting the plan in place, is making sure you understand how you psychologically respond to a market crash when you're younger versus older, Dan.
Well, psychologically, when you're talking about the money and retirement planning, it comes down to one simple thing. Before retirement, you were planning a maximum opportunity for growth with the maximum risk, which is great. You should have. But now, 5 years away from retirement, in retirement, you now have to switch. We don't want you to get rid of that maximizing or maximize word. We just now have to shift your thinking into maximizing your income on a dependable basis that'll last for as long as you live. And think about, is maximizing growth or maximizing income more important for retirement? And 100% of the time, maximizing income is what will enhance your lifestyle and allow you to do all the things you want to do, whether that's travel, help the kids, the grandkids, do a remodel, buy a car. So we need to maximize income. You're back with Dan Ahmad and Jim Files, the Peak Financial Freedom Hour. Today, we are talking about what retirees worry about. And we're going to end the show on two items. The first is, I am terrified about running out of money during my lifetime and worry I will be poor one day. And the second is, I don't have a plan in writing and I worry about my money, so I can't sleep. So both of those are kind of tied together because there's two things we can do to answer these worries. We know every person's feeling this way. So the first is to make sure we create a plan that allocates some of the assets into an asset that will give them an extremely high level of income guaranteed to be paid to them for as long as they live, which is the only way we can guarantee we won't be poor someday. And you have to decide two things. Do you want to try to be rich by being very aggressive and hope things work out? Or do you want to guarantee you're not going to be poor? And anyone who comes to us always answers, I want to guarantee I'm not going to be poor. And that's how we help them. Then once we now set up a plan that will give them this high level of income that's going to last for as long as they live, we then make sure everything about their money, including that plan, how much income they're going to get that is guaranteed to last for as long as they live, every single thing is in writing so that they don't have to worry about their money so much and they can sleep better.
You know, the happiest people that we meet that come into our practice are people that have a pension, right? They come in, they sit down with us, they have a pension, they have money in a portfolio, and they're happy because that money in the pension is coming in every day, every week, every year for as long as they live.
Well, think about it. The University of Chicago has done 3, 4, 5 studies over the last 2 decades that shows the happiest, healthiest, and longest lived retirees are those that have the highest amount of guaranteed income, which comes from pensions, Social Securities, and annuities. So what you're saying is exactly true. It's already been proven by University of Chicago.
Yeah. So wouldn't it be cool that if you really understood that you can take some of your money, not all of your money, but some of your money, and you can create your own personal pension? You can have a pension just like the people that have a pension that you're probably jealous of, right? Because when you have a pension, that income comes in every day, every week, every month, every year for as long as you live. It's guaranteed never to run out. You can actually do that with your own asset base. And by doing that, it makes you happier because if you're in retirement and if you wake up every morning and you have Social Security coming in, which is an income source, but all the rest of your money is coming off your asset base, which is in the market, and the market goes up or down, you're concerned both ways, right? Whereby if you have some of your money positioned in your own personal pension, that is a guaranteed income stream to supplement your Social Security income.
Well, how about this as an easy question for people? And see how they answer because it tells them what they should do. Let's say someone's out there that has $3 million of assets right now. Okay. And they have to try to use that to create income. Maybe they have to use the 3% rule, which means they can take out 90,000. Would they rather have $3 million that they have to worry about going up and down and they can't take much income? Or would they rather right now have $180,000 in a plan that would guarantee their income for as long as they live? Think about that. So that's saying, would you really rather have saved $3 million in your 401ks or 457s or 403bs like you've done? Or would you rather get a pension right now? And everyone's going to say, I want the pension. I want the $180,000 of guaranteed income. And that's really what you're talking about.
Yeah. Well, if you take it a little bit further, Dan, take that $3 million. The safe withdrawal rate right now is 3%. You have $3 million, you can safely take off 3%, which is $90,000 a year. And mathematically, you have a 95% chance you won't go broke. Doesn't mean your money won't drop in value. It means you just won't go broke.
And it doesn't mean you won't run out because there's a 5% chance you'll still run out.
Yeah, you don't want to be that 5%. Now, what if you said, okay, I'd like your 3-bucket rule. What if I took some of the money and took maybe $1 million and stuck it into the guaranteed bucket? Now, all of a sudden, let's say you're going to defer for 2 years. You're not going to start the income for 2 years. You would get about $75,000 to $85,000 of guaranteed lifetime income, almost as much as you would have gotten off your $3 million at 3%. You still have the $2 million left over that you can invest in the market and be aggressive and take risk with.
Well, that's basically, you're talking about leveraging your assets the most efficient way, right? Because right now, retirement, growth is not the most important thing. If that is your most important goal, then our firm can't help you. We just don't focus on maximum growth without having a plan, because maximum growth is just saying you're willing to risk it. Fine, that's okay. We're not saying you're wrong. We're saying that's cool. Just understand the risk. What we're saying is we have to mitigate the risk to maximize the income, because we see how maximizing the income literally changes our clients' lives, not just a little bit. I mean, it completely changes. We saw clients 2 weeks ago. They came in, they were living off of their $20,000 pension and their $50,000 Social Security, $70,000 a year. Their budget, thank goodness, bare bone budget. I don't even know how in the heck they did it. It was like $5,000 a month. And I said, okay, is that what you want? They said, no, but we have our $2 million of assets and we don't know how to use them. And we're afraid it's going to run out. And our broker says, wait, CPA says, wait. And we're like, we saved $2 million. Why do we feel poor? Why do we feel poor?
Yeah.
And they did. They literally felt poor. We put a plan together that allowed them to jack their income from 170 up to $200,000 a year, which now gave them a net income of about $14,000 a month versus $5,000. How does that change their life? And what is the impact on having about $9,000 more, $100,000 per year, $9,000 more per month than they currently have?
That gives them financial freedom, right?
And only at about a 20% federal and state tax bracket.
That gives them financial freedom. They know every morning when they wake up, they have the freedom to do what they want to do in retirement, what they dreamed about doing in retirement, and they're not hostage to the ups and downs of the stock market. You still have money in the stock market in that plan. We're not getting out of that. We want money in the stock market for growth, but you have enough income there, guaranteed income, to make sure they can do what they want to do in the retirement.
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.